Investment strategies for wealth. Achieving your financial goals starts with a dedicated, effective wealth management strategy for saving and investing. With changing tax and financial laws and all the options you have as an investor, it's hard to navigate the complex world of investments. With the right tools and knowledge, you can map out an investment journey that will help you take small steps to reach big goals, laying the groundwork for long-term financial success. This guide walks through top wealth management strategies to achieve the kind of growth and stability you're looking for. Identifying investment goals and risk tolerance. These two components go hand in hand: your goals and your risk tolerance. Setting clear, actionable, and attainable goals helps you create a strategy that allows you to reach them with measurable steps along the way. Set investment goals by considering why you're saving money, what you want your future to look like, and when you'll need access to this income, such as in retirement. Consider each income stream you have and how that may change in the future. Bring in any business or professional aspirations, as well as how you'll support your family, their goals, and your legacy. Goals could also relate to giving money to causes you care about, saving for healthcare expenses later in life, or gifting money to loved ones. Then, to assess your risk tolerance, ask yourself these questions. Am I comfortable taking risks with my money? Do I prefer a conservative, moderate, or growth-focused approach? When will I need these funds in both the short and long term? How will I feel if I lose a lot in a market downturn? What kinds of biases and past experiences impact how I feel about risk? It's also important to talk to a financial advisor about historical trends in the market and what they mean for the risks you are comfortable taking. Different levels of risk tolerances and varying goals both influence the choices you make in your investment strategy. Diversification, the key to balancing risk and reward. Ideally, your investment portfolio will include the perfect balance of securing your funds yet seeing substantial growth over time. What perfect looks like varies from person to person, depending on the characteristics and factors identified above. However, all investors can benefit from embracing one important concept: diversification. Just like it sounds, diversifying your investments means you're investing in different types of accounts and funds. There are a few different asset classes to consider and markets to invest in. Why is this important? Because the market does swing, and if everything is saved in one area, like the stock market, you could lose everything if it crashes. The real estate market is similar. But investing in both means you're putting your money into high-growth opportunities, but also spreading out the risk. Carefully considering asset allocation is a must to create the right investment strategy. You may think the safest option for investing is a standard savings account, which can provide some interest gains. However, investing solely in these places means you could be missing out on the growth that stocks, bonds, or mutual funds provide. That doesn't mean cash accounts aren't also valuable to help with diversification. You should consider keeping an emergency fund in a savings account so you can take advantage of its liquidity when you need it. Long-term versus short-term investment strategies. Throughout your lifetime, your investment strategy will change. Updates may need to be made during life changes like marriage, divorce, having children, adoption, losing loved ones, or dealing with medical problems. In addition, you will probably want to change course when you're getting closer to retirement. Short-term investing is often more concerned with preserving capital since you don't have as much time to recoup losses in the market. Long-term investing, like planning for retirement when you're still young, allows for more flexibility and potential risk since you have time to recover those losses. As you near retirement, you may decide to take on a more conservative investment approach so you can start protecting what you've saved for upcoming withdrawals. There are benefits to both short and long-term investment strategies. Remember that taxes also play a role. Even if you invest in taxable accounts and risk paying high capital gains tax, if you hold investments in the account for more than a year, you can reduce your rate to long-term capital gains tax, 0%, 15%, or 20%, instead of short-term, which will be the same as your tax bracket rate. With long-term investing options, like 401(k) and IRAs, you have more opportunity to take advantage of tax benefits, either deferring the tax until retirement with traditional accounts or paying tax on contributions and enjoying tax-free withdrawals later. Regular review and adjustment of your investment portfolio. Because so much can change in your life, and the plans you make. Regularly reviewing your portfolio and adjusting your strategy may be necessary. Your financial goals could shift and probably will over time. Market conditions also change, which will impact your strategies. Seeking professional advice ensures you're not trying to do it all on your own. Financial experts understand what's happening with the market and how you can minimize your tax liability with better investment decisions. Incorporating the right investment strategies with behavior. Being proactive about investment management means considering tax implications, aligning strategies with your financial goals, and working with a professional for expert guidance through any type of market. The team at Avier Wealth Management can help you identify goals, plan for both short and long-term financial needs, and prioritize tax planning to minimize your liability. Value investing. Seeking undervalued opportunities. Value investing focuses on identifying undervalued securities trading below their intrinsic value. Fundamental analysis, including examining financial statements, assessing business fundamentals, and evaluating market trends, is key to identifying potential value opportunities. Famous value investors like Warren Buffett and Benjamin Graham have demonstrated the effectiveness of this strategy over the long term. Dollar cost averaging. Smoothing out market volatility. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps investors avoid the pitfalls of trying to time the market and instead benefits from the principle of buying more shares when prices are low and fewer shares when prices are high. Over time, dollar cost averaging can result in a lower average cost per share and reduce the impact of market volatility on portfolio performance. Tax-efficient investing. Minimizing tax impact. Tax-efficient investing focuses on optimizing investment returns while minimizing tax liabilities. Strategies include utilizing tax-advantaged accounts such as 401k IRAs and health savings accounts (HSAs) to defer or avoid taxes on investment gains. Implementing tax loss harvesting, where capital losses are used to offset capital gains, can also help reduce tax liabilities. Implementing a well-thought-out investment strategy is crucial for achieving financial success and building wealth over the long term. By diversifying portfolios, strategically allocating assets, seeking value opportunities, employing dollar cost averaging, and optimizing tax efficiency, investors can navigate market volatility and maximize returns. Remember, investing is a journey, and staying disciplined and committed to your investment strategy is key to achieving your financial goals. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.